Swapnim Mangle is asking that are floater funds helpful in reducing debt funds risk in fixed income space? Also, advise what are the ideal investment horizon for such funds? Uh, Let me just explain you. There are three parts to this question. One is that what are floating rate funds? Floating rate funds are funds which invest in floating rate bonds. Then the question is what are floating rate bonds? Floating rate bonds are are bonds issued by companies where most bonds are issued with a maturity, 10 years bond, and there is a coupon. And depending on the credit quality, quality of that company or financial health of that company might give you high rate of return if the company is in poor financial health, because there is a greater risk of default. And if the company is in its great health, great financial health, then the coupon or the interest payment will be lower. Floating rate bonds are something where the company doesn't give you for the term of the fund, for the term of the bond. They don't say that you will get 9% over the next 10 years. It says that the interest rate will be reset every year in line with the changing interest rate. So there is no guarantee of interest. There is a guarantee of interest that it will be reset. You don't have the long-term guarantee of interest. So if today the interest rates are low, the floating rate bonds actually make sense, because tomorrow, if interest rates go up, then these will be revised upward. But in good times, when interest rates are at a higher level, then it doesn't make sense, because they will also get reset when interest rates get lower. And in India, we don't have too many floating rate bonds issued by the companies. So there are derivatives which are created whereby the fund managers buys those derivatives to create artificial floating rate bonds. They buy the bonds and they buy derivatives, options, whereby the character of the bonds change. And so put and call options, put options, or to ensure, and derivatives mounted around that. It's a complex formula, but that is how it is made available. So floating rate bonds or floating rate funds make sense when you are investing in fixed income funds at a time when interest rates are low and they can go up, and then you will be deprived of that. So they will be revised upward. So after I have explained this, I think it becomes self-evident that what is the ideal investment horizon of such funds? It doesn't matter. The interest or the return from such funds get revised in line with the changing interest rate. And you are asking that, how safe are they? It has nothing to do with the safety of, all these things which I am referring to. They are talking of the interest rate risk. The other significant risk of debt fund or debt or investing in bond is that how assured are you of getting your principal back and interest on time? And that is the credit risk. What is the likelihood of a company defaulting on its payment to its bondholders? And that is something which depends on the rating. I would say that err on the side of caution. Floating rate funds or not, it entirely depends on the kind of credit they are taking. So just be careful. Also, I feel that, floating rate funds, there are 2-3 red flags, or, red flag in the design. One is that we don't have readily available floating rate bonds. The other is that it has to be artificially created, so it requires certain transaction and cost. Third is that you will get interest rate little more than in line with the prevailing interest rate. And then mutual funds will have expenses. So the prevailing interest rate minus expenses will turn out to be prevailing fixed income return, nothing more, nothing less. So don't expect anything dramatic. And what are you trying to guard yourself against? You are trying to guard yourself against interest rate rise, which will enhance the return of some of the bonds, but these bonds will also get reset. Why not be there are other ways of simpler ways of achieving this. So I would say that today it has come on the forefront. 2-3 floating rate funds suddenly have posted some decent return, and investors are getting attracted to it. But no, they have been in existence for a very long time, and I don't think they have any earth-shattering performance for you to really get attracted to them.